Well, Manishi Raychaudhuri is with us, Chief Executive Officer at Emmer Capital Partners. He's joining us now. Manishi, good to have you with us here. Good morning. Thank you for joining us. So it's going to be an interesting news week. You know, I'm reminded of something I read from Elon Musk. I think yesterday he posted. He said, "Success is not guaranteed, but entertainment is guaranteed." So, is that the?
Right.
So should we be ready for some entertainment starting next week? And but the jokes aside, what's the view?
Right. No, you're right. I mean, on 20th, we will have the new administration formally taking shape in the United States. Everyone has been waiting with bated breath for President Trump to come in and actually implement what he has been talking about. As we've seen historically, that there's a difference between what is talked about in the electoral promises phase and what is actually implemented, when a new administration comes in. But this time around, I'm afraid, I think the market will have to navigate some of the, so-called treacherous and vicious outcomes that might result as a consequence of this new administration coming in. It's been clearly articulated that there will be new tariffs, higher tariffs on most trading partners, particularly China. And there could be some difference regarding the modalities of how these tariffs are imposed. So over the last few days, we have been hearing about they being imposed in a phased manner, maybe 2 to 5% increment every month, which might indicate that the administration is conscious about the impact on domestic inflation as a consequence of these tariffs. Now, that is good news, but we will actually have to wait for how each of these policy articulations take shape. How exactly would the illegal immigrant deportation take place, and in what quantum? What impact would it have on services inflation in the United States? These are the issues that the market globally, not just in India, not just in Asia, would be grappling with, at least in the first quarter of this year. And so, prepare, brace for volatility is my single sentence message. Equity markets or broader financial markets will have to brace for significant degree of volatility, as we've seen in the past couple of months. And I think that would continue, at least in the first quarter of this year.
Manishi, hi, great to have you on the show this morning. So let's talk about the Indian market and how you can approach it now. We've got a fair amount of correction at the index level and, a lot more at the stock level. So how are you looking at the portfolio? Just give us the top-down view, what the top overweights would be, and whether, a portfolio that you recommend right now, whether it'll be more capex and manufacturing oriented, or whether it'll have more of a consumer tilt, expecting a staples and rural recovery.
Right. Okay, let me first come to the top-down picture, and then I will drill down to each of the sectors and, what we recommend about each of the sectors or some of the important stocks over there. First of all, if one looks at this recent narrative about India, about growth slowdown, the most recent quarterly growth was about 5.4%, and growth estimates are being slashed by independent economic watchers and the banks alike. It looks like this year, that is the first, the fiscal 25, we would possibly settle at somewhere between 6 to 6.5%. There is also the narrative that this is being engendered, this is being generated because of a degree of government capex slowdown around the time of the general elections and a bit further, which would eventually recover as we enter into fiscal 2026. There is a degree of consumption recovery that's also happened during the festive season, which would have its impact on earnings. So that's really the narrative going forward. What really worries me about India are two things. Number one, from late September, earnings estimates have been declining. They have declined about 6 to 7% if you look at consensus EPS estimates. And this has happened across all sectors. I mean, I don't think any sector has been immune to this, be it domestic or international revenue dependent. Number two, the valuations are still relatively high despite this correction that we have seen, even though the market has declined about 10 to 12% from the September peak. Earnings estimates have also declined. Therefore, the valuations haven't declined to that extent. Forward price earnings multiple for any of the large indices are still about 22 to 22.5 compared to the last 10 years average of about 19 to 19.5. If you look at India's price earnings or price to book premium compared to Asia ex Japan, price earnings premium is still about 60%. And that compares to the 40% average of over the last 10 to 15 years. So I would think that relative valuations in India still have more room to correct. If earnings estimates had been increasing, I wouldn't have been so concerned. But they're not. Earnings estimates are declining, which makes cheap valuations look expensive tomorrow. So that is my near-term concern about India. The market has proved resilient because of strong domestic inflows. There are about $2.8 to $3 billion of monthly SIPs that we are seeing nowadays. But one would have to see how long that that is able to keep the markets afloat. I would, in the near term, therefore, be slightly cautious about the market. We have kind of a neutralish stance on India. If I were to drill down to the sectors, number one would be the private sector banks. They are the unloved sectors in India, and particularly if you look at some of the top, private banks, which not only are gaining market share, but also have relatively clean balance sheets. Number two, I would focus on the sectors that are catering to manufacturing and infrastructure capex. There was a degree of slowdown in government capex, and there's a delay in private sector capex, no doubt. But if you look at the longer term, over the next 5 to 10 years, that's almost certainly going to be the biggest theme in India. Third, I would look at some of the sectors which are catering to US revenues or demands, global demands, particularly arising from the Western Hemisphere. IT services come to my mind. Even though this sector has been weak of late, I would think that the relative resilience of the United States, and particularly the US financial sector, would eventually stand in good stead. Many of these companies have declined quite a bit. They're possibly offering, a near-term entry opportunity at these prices.
Okay, all right. Hi, Manishi. Good morning and good to see you. And just to clear that point on tech, Infosys started off gap down. I think it made it low, and from there it's seeing some kind of buying interest. So what's the call on tech? Sorry, I missed that.
So as I said, that currently there is a clear degree of difference between how the emerging market economies and the developed market economies, particularly the United States, are performing. There's a clear narrative, and I think it's correct, of US exceptionalism. That earlier expectation of a US recession or slowdown, that's been belied. We are seeing strong numbers coming out from the job market. The most recent CPI numbers have also been encouraging. It seems that the US economy, while clearly not as strong as in 2021 or 22, would still chug along. And there are some sectors within the US economy, particularly the US banks. Their numbers indicate a significant degree of growth and relatively resilient performance, which obviously means that the beneficiaries could be the emerging market companies or sectors which cater to the demand from those companies in the United States. So the Indian IT service companies, they clearly fall in that bracket, as do many of the tech hardware companies, let's say in Taiwan and Korea. In fact, if you notice TSMC's results, just day before yesterday, not only did they surprise the markets with the numbers, but they also gave a very strong guidance about the next quarter and the next year. I think, in a sense, that is, a case of morning showing the day. So that is, in a nutshell, my opinion about the Indian IT companies. Possibly not as strong a case as the IT hardware companies or the semiconductor companies in East Asia, but still, a relatively stable story nonetheless.
What about quick commerce as well as renewable energy? We had spoken about it in the past as well.
Yes.
And they were the so-called fancied sectors. Some of the stocks have come off the top. In quick commerce, you have very limited opportunity out here. Would you be a buyer?
You see, again, I said there's a difference between how we treat these companies in the near term and the long term. In the near term, the valuations appear daunting, but in the long term, as I said earlier in my previous discussion with your channel, India, in a sense, is about 15 to 20%, 20 years rather, behind China. And if one looks at how these companies in China, the Alibaba, Meituan, or any of the other, the quick commerce and food delivery companies, how they panned out over there, I wouldn't be surprised if such a similar story pans out here in India also, in particular because the penetration level of e-commerce, food delivery, and quick commerce is still really low. Even after the strong growth that they have had in the past few years. I think investors, if one chooses to buy these stocks today, will have to be patient. They will have to wait for the growth to pan out over the long term to make significant returns from the stock prices.
All right, Manishi, got that. Thank you very much for joining in and sharing some perspective in the Indian market with us today. Well,